Hello, everyone. Good morning, good afternoon, good evening, wherever you are around the world listening. This is Joseph Trevisani. Welcome to another episode of Market Directions Interview, brought to you by Worldwide Markets and FX Street. Today, I'd like to welcome an old friend of mine, an old colleague of mine, and a well-known technical and fundamental analyst here in New York, Edward Moya. Mr. Moya, nice to see you again.
Joseph, the pleasure is all mine.
We have to, as I say very often to my guests, we need to go out again, and we of course will. But beyond that introduction, one of the things I think that interests retail traders the most is how people who are versed in the market arrived at that status. Because all of us, there's no place to go. You can go to an educator, but most of us have approached our current positions through a long period of apprenticeship. Both for technical analysis, for their knowledge of economics, and also for sort of their personal approach to trading. I know we know each other from back at FX Solutions. Can you give our listeners some idea of how you approach this, how you came to be interested in foreign exchange, and how you went about learning what it is that you now know and share so eloquently with everyone in the market?
Definitely. Well, I started following the forex market in the mid-2000s. Before that, I was trading financial and technology stocks and learned a couple good lessons during the tech bubble and the crash. And eventually parlayed those skills that I picked up, which was simple technical analysis, studying multiple time frames. And then I fell in love with the forex market because it allowed me to trade during off-peak hours and providing me with more leverage, which eventually I learned not to lever up as much. And eventually, through trial and error, adapting my skills, learning different markets, because over the past 11 years of FX, we've seen quite a wide range of different markets. And right now, you'll always evolve your trading strategy. And that's kind of where I am right now.
When you approach technical analysis, technical analysis, of course, has some very interesting aspects. One of them, of course, is the self-fulfilling aspect. But aside from that, how do you approach? You've mentioned separate time frames, looking across different time frames. But there's often a split between the patterns. One way of analysis, patterns on charts. You can use the same patterns with candle charts, with bar charts, with almost any chart. And then you have the oscillators and the indicators, which give you a different sort of sense of where the market is. What are your favorite, or at least your most instructive patterns? And then how do you feel about particular indicators and what they're providing you about the information on the market?
Yes, well, my first and by far my favorite indicator is using the Fibonacci tool, and I use Fibonacci ratios to confirm a wide range of technical analyst patterns, from the ABCD pattern, double tops, triple tops, head and shoulders, Gartley patterns. These are a wide range of different patterns that you can see on any time frame, whether you're looking at a 5-minute chart, a 30-minute chart, a daily chart, or even a monthly chart.
Right.
And you'll see these patterns constantly reoccurring. In addition to that, I always, keep an eye on what the trend is, and I also, especially in today's market, looking at previously traded levels, and also using trend lines. You'll see that a lot of times when people identify stop losses or take profits, they're positioning their orders around these levels, and those are some of the key ones that I'll do on a daily basis.
When you look for a particular entry point, when you're looking to advise people or to trade yourself, do you use a particular chart pattern or a particular indicator more often with an entry point than any other, or a combination of them?
It depends on how the market's been trending recently. So right. if we're taking a look at, let's say, the British pound, well, right now, for the most part, it's been range bound over the last several months, ever since
the Great
Brexit
Fall,
vote. The Great Fall, and depending on your broker, you'll have a different low. But you'll see that when we have the market trending and it's sideways, well, in those instances, I'll trade on shorter time frames. I'll identify previous daily closes, daily highs, looking at what also contributed to those moves. So, for instance, in addition to all the technicals, I'll also keep an eye on what was the catalyst for that most recent high, for that most recent low.
There used to be a cliche from them, at least I was told by various traders when I started trading long before you did. Always remember why you got into a position. One of the things that's very easy to do, well, one, it's very seductive to try and make money out of every position, which is a uniform disaster. But to change your analysis as the market moves and as you retain or regain hope of making money on one particular position. How do you make sure psychologically that that is not something that you do? How can you advise people to stay strong, if you will, when it comes to their own analysis?
But one of the important things in trading is to be able to accept a losing trade, accept a losing streak. Part of my history is before I became an analyst and worked with some of the top research minds like yours truly, I
you don't mean my mind, do
you? Joe, you're one of the best out there. But
we're not going to go there. Okay.
But what I did have the privilege of doing was studying, helping existing clients and analyzing their trading behaviors, analyzing exactly what their methods were, and helping them understand the different market conditions, and seeing exactly where, and hearing their rationale on where they're placing their take profits, their stop losses. And it's important. You could have the best trading methodology. It could be running 90% accurate, but if you can't accept that losing trade, if you can't accept, I was on the side, this trend was strong, there was momentum behind this move, and the trade didn't work out, and then the same opportunity comes in again, and then I'm going to just increase my position. Instead of trading one standard lot, I'm going to trade two. I'm going to make that. You have to be disciplined. You have to be disciplined. And in this market, it pays to be disciplined. It pays to trade for, just be able to say, okay, today was a losing day, and move on.
Yeah, one of the many cliches, not many, but several cliches. When I first started trading, back in the early 90s on a bank desk, there was no instruction about anything. Threw you in there. I showed up with my tweed jacket. I was an ex-English major. I had no clue what was going on. And so what you would get advice from the senior traders and the others were all these series of cliches, which you could tell were cliches, but they all had, if you could understand them, meaning for what you were doing. One of them was, when you learn how to lose money, you'll know how to make money. It made zero sense to me at the time. But after about 2 years, it did make sense. I mean, one of the most important things I've always thought about trading is your attitude, is the necessary risk management and discipline that you must put into it. That's why it's hard. It's not because the analysis is hard. How do you advise people on this? How do you tell them that this is what you really have to pay attention to, rather than that brilliant exit and entry point?
Well, first it's understanding how you're going to be trading. So it's understanding, are you actively trading? Are you swing trading? And once you have that, you have to understand how much money do you have? What are you comfortable in risking in each position? And more importantly, you have to understand that if the market is not providing you with a clear signal based on your trading methodology, don't force the trade. There's so many times I've seen traders just say, okay, well, I have 4 things that I check off before every trade. 3 of them are ready, but the 4th one's not so, and then they rush it. And I'm sorry, go ahead.
No, you go ahead. You're talking.
No, I was just going to say that sometimes they'll prematurely enter a trade. So instead of entering the trade, maybe at let's say for the British pound, let's say it was like 124.50. They're going long. They decide, I'm going to go long a little bit earlier. And guess what? When they put their stop loss, they lose that market. They lose that breathing room, and then they get stopped out. So it's important to stay disciplined to your methodologies because you need to give it a fair shot. And that's one of the key things that I've noticed with a lot of traders. They'll rush that trade, and it's important to stay disciplined to your methodology.
Yeah, I used to work with a guy at well, never mind the bank, and every once in a while he would say to me, you know, we're talking about trading. This is so long ago that you could actually smoke on the trading desk. A long time ago. And he would say to me, well, you know, I'm going to take a flyer. And you know what happened? Every one of those flyers lost money, just about everyone that I remember. Another thing I wanted to ask you about is, you know, there's such variety of information available now, both chart, time frame information, and economic information. For charts, how do you narrow down between all the time frames that you're looking at when it comes? You can look for the minute, the 15, the 30, you can go on and on. How do you narrow down? Which ones do you think are most important to the type of day trading or limited time frame trading that most people involved in the retail market do?
So it's been over a decade when I've been applying pattern recognition, and for me, I've consistently used 4 or 5 if you count the monthly chart, but that's only for big picture stuff. But I use 4 time frames. It's been the daily chart, the hourly chart, the 30-minute chart, and the 5-minute chart. Those have been the key time frames, and depending on where I'm seeing the most supported level or the key resistance being provided, I typically will either go between the 5 and the 30-minute time periods.
What do you look for in the different time frames? Do you look for different things, or do you look for basically the same thing be confirmed again across all those? Say if you look to have a pattern, are you looking for the same pattern to be applied and to be evident across all those time frames, or are you dividing it up?
Well, for the most part, it depends on how much of a move I'm trying to capture. So if I'm trying to capture, let's say, a 150 pip move on dollar yen, I might be focused more so on the 30-minute chart and just
Wonder if we've lost our connection here, folks.
time.
Mr. Moya has completely stalled.
Joseph, can you hear me?
I can hear you now. You stalled for a minute. There was an intervention from aliens on Alpha Centauri there. They're monitoring our conversation. It's either that or it's the NSA, but don't say anything about that.
They're fine people.
They both are, but we'll leave that alone. So anyway, we didn't get most of your answer about the different time frames.
Yes. So depending on the trade I'm trying to capture. So if I see an opportunity where I think I'm going to try to capture a 100 pip move on, let's say, dollar yen, I'll focus on maybe the 30-minute time chart. I'll also take a look ahead of what are the key events that are happening. Is Governor Kuroda going to be speaking? Are we having any rate decisions? Are there any key economic data points? Are we going to see inflation data from Japan? Are we seeing Fed Evans speaking again? And has the economic data been better? Are we looking for him to change his bias? So there's a lot that I take a look to.
No, go ahead. We have a little delay here, which is making it a little slow. So go ahead.
Yes. So I'll take a look at that, and depending on where I see the economic data trending, where I see the central banks, where they're positioned, I'll then decide on how big of a move I'll try to capture. So I'll look at those time frames, but typically a 30-minute time period. And if I have a confirmation, if I have key support where I know that level's been defended, I'll then feel comfortable in entering that position.
Interesting. You know, I used to look when I was trading. I do mostly analysis now. The farther out you go on the time frame, of course, the longer the time frame, the more you're involved in trends rather than particular price action, which may give you an indication of entry or exit points. But to move on to the other side of that, of course, when you look at exit points, so you're in the trade, not the stop, which tells you you're wrong, but the profit exit point. do you use any particular methods or any particular indicators or patterns
Well,
to
I'll
give
take a
determination on that?
I'll take a look at the trading range that we've seen that currency pair have over that week or month, and I'll then also take a look at some of the most recent swing highs or swing lows. And a lot of times, if I'm identifying a key breakout, I'll then use a Fibonacci expansion tool, and I'll some of the favorite levels I have is the 127.2%, 161.8% levels, and sometimes a 261.8% if it's on a major move up.
Yeah, it is interesting. You know, I've heard this from many traders and analysts, because we know the Fibonacci series is something that goes back to, I believe, the 13th century, as far as establishing the series, not of course applying it to trading. And it does turn out to be, in all the interviews I've done, one of the favorite indicators that people and that analysts and traders always cite when it comes to exit points. And it's always been my idea that the reason is because if for any particular move, you know that there are going to be people involved in it. There are going to be traders who have that right position. Well, once you're in the move, the most logical and necessary item is, where do you get out? And it gives everybody this is one of the self-fulfilling aspects of it, I think. Do you think that it's going to be kind of silly, but do you think that its main interest or its main predictive power is exactly along those lines, along the psychological aspect of markets more than almost anything else?
I completely agree. And when you take a look at how trading has evolved over the last several years, we have high frequency trading, we have algorithms trading, and a lot of these models are incorporating that Fibonacci. So
I think you're right.
So if I'm targeting let's say the 161.8 expansion level, well, let's say if it's at a specific level, I might go 10 pips before that level, because everyone's targeting that specific point. And that's kind of where you see these patterns constantly recurring. They worked in the 80s, they worked in the 90s, they worked in the 2000s, they worked during the financial crisis.
They work.
And it's something that's been we're going to continue to see. Sometimes the levels might change a little bit, but for the most part, that's how I've been approaching the market.
Yeah, one of the interesting things about the Fibonacci series is that particular series of numbers you will find duplicated or replicated in nature, in flower forms, in shellfish forms. That particular ratio seems to be very deep into creation, without getting into any particular theological discussion about it. Another thing I wanted to ask you about is there's been a great change in the market itself, in the way people trade. You mentioned it now, and I want to use it, is what algo traders do, what high frequency traders do. You know, the cell phone towers and the links up at the New York Stock Exchange data center, which is not far from our office in Moya. And people arguing about over getting the same length of connection so they can do the same trading. What effect do you think that advent of this type of trading, which is computerized, has had on foreign exchange markets?
Well, in some instances, it's wreaked havoc. We've had some key moves that have had an overextension of a certain move. Whether it was the Brexit vote, whether it was the flash crash, you'll see that we have a lot of times these algos will help just really take a trade to the next level. And the most important thing, though, is for the traders to remember, we could see these over-exaggerated moves at any time, and that's one of the reasons why it's important to stay disciplined. It's important to trade with stop losses. You could see the market have just some type of 3%, 5% move for no reason. And it's important to not have that be the bane of your trading account.
You know, it's tough, because the best example of this, of course, is when the Swiss cut their peg. I mean, I have never seen, in all my years of trading, I've never seen a move like that. And there's no doubt that was made much worse by the kind of automatic execution you have. On top of that, that move was so fast that even stops were probably slipped hundreds of points because there was simply no pricing. I mean, it looks, on the charts like it's a continuous line, but for most of that time, there were no prices. And this is one of the risks of foreign exchange that is not really as evident in other markets. Do you ever bring this up with traders and tell them, this is part of the risk involved in the business?
Definitely. And you have to understand that these conditions are always going to be out there. We have some central banks, the Czech central bank, they have right now, they maintain a floor. We're going to see other central banks have to abandon their quantitative easing methods, change their objectives, and you're going to see these historic moves. So it's I mean, the British pound is a favorite because in 1992, when we saw them get rid of the rear, it basically, you're going to see these possibly 10, 25% moves. So it's important to understand that that's part of this market environment.
In a way, these moves, which are dangerous as they are to the markets, dangerous to individual traders, restore, though, a sense of volatility. Because, a lot of the times, I think the algo traders and the others keep the market in a range because they're looking for very small moves and they're just doing it very quickly. So they're providing more liquidity, essentially, on the side of a narrow range. On the other hand, they're also trying, when you get these violent moves, to take advantage. I mean, I remember from the days when, the only people were trading in the markets were bank traders with voice brokers. And even then, you would get prices simply disappear. And nobody knew where the market was. So we're essentially back to that position. And that makes it very difficult for retail traders kind of to get a grasp, and traders in general, to get a grasp on the market. But moving on from that. One of the things I know that you specialize in is using news flow to basically generate trades both in and out. Can you tell us a little bit about your approach to that? Because news flow is, by its definition, unpredictable. You know when it's coming out, but you don't know what it's going to be. So how do you incorporate that into your trading and your trading knowledge and your trading advice?
Well, what I like to take a look at every day is see exactly which central bankers are going to be speaking, which economic data is coming out, and specifically understand where that central bank has their current bias. Where are they looking to taper? Are they looking to become more accommodative? And then understanding the key data that will influence those decisions. So whether it's CPI data, GDP data, EFO forecast, and any survey that might really provide a changing of their bias, and then understanding which key members are hawks, doves, and seeing if they're changing their positions. Now, taking a look at that last central bank decision, were there any dissenters? Who dissented? Who are we starting to see a shift in the other members? And when you take a look at that, what I'll try to identify is the key strong trend, and seeing we might have some noise. So maybe a Kaplan will make a comment, and we'll see a 30 pip move, but then we'll see the market come back to the normal trend. Well, I'll trade that noise. I'll trade that little blip up, and then try to take advantage of that that discount if I'm right on that trade.
Do you mostly look at central bank commentary and rate decisions, or do you branch out farther afield to particular statistics? For a while it's not quite as popular as it was. Again, and we're not getting much attention. It was American non-farm payroll, and there are other statistics around the world. Would you incorporate those also into your advice on what statistics perhaps to trade and what not to?
Well, non-farm payroll is one of my favorite releases. I mean, historically, it's really helped put FX on the map, or at least for U.S. traders. Everyone, it's an easy time frame. You have volatility, and for the most part, it's the Fed's mandate. They have to, they're focused on jobs, And what we're inflation too, but what we're going to see is that these key data, whether it's the ADP report, which well, a lot of people will use that to help price their forecasts for non-farm payroll. So it's taking a look at all these key different indicators, and whether it's an ISM manufacturing statistic. I try to incorporate all the major ones, and for the most part, just identify the key trend. And specifically looking at the U.S. dollar, we've had one great cycle. The dollar has been extremely, extremely strong over the last couple of years, and what we're at cycle's end, and whether or not we still see a Fed that maybe they do hike 2 more times, maybe 3. The dollar may not necessarily see that next major leg higher because it's extremely overbought.
It's true. It's kind of interesting that since the election in November, much of the focus, it almost seems, to the market has shifted from the Fed. I mean, the Fed raised rates in March. They're probably going to raise, and nobody seems to be paying a great deal of attention. Focus seems to have shifted a bit to DC and whether or not the current administration is going to be able to accomplish anything and what they do. So it's almost that the Fed has shifted into the background. But let me ask you one more question about Fed policy. With the economy growing about 1%, so says the Atlanta Fed in their GDP now estimate, in the current quarter, which is up in a couple of days, and 1.9% in the prior quarter, you're averaging less than 2%. Those 2 quarters, that half year, is 1.45% if that estimate is correct. This does not seem to be a traditional environment for the Fed to be initiating or continuing a rate cycle. What does one make of this as an analyst looking to say, 1, what is the Fed going to do, and 2, what's going to be the effect on the economy in the US dollar?
Well, I think you hit the nail on the head. The Fed right now, they are not really in a position to hike in May. That's pretty much heavily anticipated. And I think right now everyone, including the Fed, is going to be waiting to see if Mr. President Trump will be able to implement his tax policies. If we see that, maybe we'll see the U.S. dollar just 5% across the board, and we'll see that next move higher. But there's going to be a great deal of difficulty in order for that to happen. So right now, while monetary policy is dictated based off of these key economic data points, right now I think the market is heavily focused on President Trump.
Yes, very much. It's interesting. The Fed has said for so long, that they're data dependent. But the interesting thing is, data hasn't changed very much. Inflation's a little bit higher. The non-farm payrolls, which is their 2 big data points, non-farm payrolls are trundling along pretty much where they have been, maybe a little bit higher. There doesn't seem to be, by any traditional measures, there doesn't seem to be any reason for the Fed to be raising rates, but they are focused on raising rates. And the question I want to pose is, say that the Trump administration has the same issues with their economic policies, trying to get them through Congress, that they had with their current policy. If that's the case, then does the Fed, what do you think? Do you think the Fed will pull back if there's, let's put it this way. If the Trump administration gets through a tax cut and gets through a stimulus program, then you can look for 6 months or a year of boosting for the US economy. If that doesn't happen, if the policies falter the way the immigration policy faltered, what does that do to the Fed's inclination and apparent determination to raise rates?
They'll have to stand pat. They'll have to stand pat. And for the most part, right now, the optimism on President Trump pushing through these tax policies is fading. So
yeah.
So as I said, this dollar has had a strong cycle high over the last couple of years. We're at a key point where we're not necessarily going to see too much of a reason for the Fed to hike. And right now, they're pricing in 2.5 for the Fed fund futures, which is one of my favorite things to follow. It's not pricing in. And if the data starts to weaken, it'll definitely go down.
I mean, it could. It's interesting. The Conference Board Consumer Sentiment was out yesterday. Was incredibly high. I mean, it was 25.6, I think. That's the highest it's been since the fading days of the Clinton administration 17 years ago, which seems like a long period. But if you take out those last 2 years of the last Clinton term, that's the highest that indicator has been since 1969. And the last days of those 2 years were also the years of the tech boom, the tech bubble. So we have this interesting coincidence between very high stock markets then and now, meaning producing very high consumer sentiment numbers. Do you think there's any relation there? And again, what does this say about the underlying U.S. economy?
Right now, the underlying U.S. economy right now, the data has been robust, but the uncertainty and the strong rally that we've seen in both the equities markets and in the U.S. dollar is right now at a critical point. And for the most part, we're not seeing the rest of the world necessarily be providing with blockbuster numbers as well. So we're at that point where all this easy money has really helped propel a lot of the key markets, and right now we're at a point where we could start to see that trade end.
The last question here, I'll just because we have to end. As far as central bank policy goes and its effect on economic, and I didn't get to a couple of topics that I would have liked to have on. We do run out of time on these things. We're looking at the same policy and the same questions that we were looking at from 6 years ago, from 7 years ago. There hasn't been any shift to a different paradigm of economic growth and central bank policy, which is sometimes, I guess you could view it as reassuring, but you can also view it as worrisome.
No, definitely. And one of the key things that I'd like to just kind of tie everything together is that's why it's so important to pay attention to where the central banks are positioned. And if you're seeing all this uncertainty with the U.S. economy, you could also then focus on some of these key commodity currencies which have been pummeled. And right now, if you're not seeing the clear signals with the U.S. dollar, you might be able to find a better opportunity with some of these other markets. For instance, the Australian dollar, the Kiwi, and also oil seems to be stuck in this range, and that might continue to hamper the loonie. So maybe just focusing on range opportunities for the Canadian currency and just the other opportunities for those other commodities.
It's another fascinating topic we're not have time to get to. Edward, thank you very much. I'd love to talk about oil because I find the relationship between oil and the oil markets and U.S. shale and technology evolution absolutely fascinating, but we can't do it today. Edward, I'd like to thank you very much. This has been Joseph Trevisani with Edward Moya of Trade the News. Thank you very much for attending, and we will see you again next Wednesday. Take care, Ed.
Thanks, Joe.